But yeah, welcome. Good afternoon. Good evening, almost. Thank you all so much for coming. There's so many of you here. It's great to see. So today we have our entrepreneurship Sundowner. Right. The topic is VC insights from Silicon Valley to Southeast Asia, and we actually have a very special guest with us today, Mr. Hemant Bhardwaj. He is actually the founder and also managing partner at Taurus Ventures. They invest in technology-enabled businesses in USA and also here in Southeast Asia. Yep, he was also the senior director at Pipedrive, which is a venture-backed company for a software-as-a-service CRM platform for SMEs all around the world. Before that, he was at New Atlantic Ventures and Crossboard Mobile, and director with Entrepreneurs Advisory Group at UBS Investment Bank. He also started his career at Citi as an investment analyst, and he got an MBA from Cornell and a BA in economics from Grinnell College, and he also now serves as Cornell University's Advisory Council for Entrepreneurship at Cornell. He has lived and worked in India, Argentina, Thailand, and also the US. So yeah, please welcome Hemant. Actually, I'll introduce the moderator as well. He is my boss, so I think he'll get angry if I don't introduce him. This is Pisam Surawat from Yotin. He is the director of Sasin Sustainability and Entrepreneurship Center right here. He's also the executive director of Bangkok Venture Club, which is the largest accredited angel investor group in Thailand. He actually, you might not know this, he actually co-produced music, film, and television projects. No, I mean, I got this from a bunch of people for local and international artists, so he's got that background, which is surprising. Before that, he actually led Style Hunt to raise more than 500K US in pre-Series A round, and he now actively helps building startups, the ecosystem, and all the ventures around here in Thailand and Southeast Asia. He mentored and judged at multiple accelerator competitions, including Digital Venture Accelerator, DTAC, Seed Stars, Hatch, Startup Thailand, and Harbour Stadium. Should I go on? There's like about 7 or 8 more. He's mentored over 1,000 startups. He's actually an EMBA graduate here from Sasin, and he will take care of you guys tonight.
Thanks so much, Koichi.
And I'll pass on to you.
Thank you. All right, I'm so excited to see you. My friend, thank you so much for coming this evening. It's really an honor for us. You can see a lot of folks who are very interested and would love to hear about your journey and about your insights.
Hopefully it's entertaining.
we can dance around and stuff too. So actually, if you don't mind, to kind of start with just how you got into venture capital in the first place. What was sort of your journey into this?
Sure. Can everybody hear me okay? I think it's okay. Not too well? Okay.
Not too well? Then you know what? We can just switch off.
It's going to be too loud. Is that better? Yep. Okay, great. Yeah, so how I got into venture capital. So I think what might be helpful is to start from day one. I was originally born in India, but had the good privilege of living, all over the world, including obviously India, Argentina, Thailand, and the US. So a common thread of, I guess, everything that I've done up to date is very international, right? And I think that stems from my parents who pretty much, moved all over the world for opportunities. So, just like Steve Jobs says, right? You look back and it's easier to connect the dots, right? And only all of this came together in the last, 5-6 years. So in any case, I spent majority of my, let's just call it childhood years in Bangkok. So Thailand is, kind of a second home outside of India. And, then I had the good opportunity to study in the US. And in 2007, I ended up on Wall Street with Citi, as Koichi had mentioned, and then also at UBS. And while I was there, I spent a considerable amount of time working on technology, media, and telecom deals. So I had a good opportunity to see firsthand, how the public markets behave regarding M&A, primarily pre-IPO, and then obviously, strategic alternatives that large corporates are looking to go through. And I'm sure some of you may be able to remember 2009, 2010, there was this name flying around New York called Uber, right? So everybody's like, oh, there's this car that can pick you up, all you have to do is open up your smartphone and it shows up. And, and then slowly, our team started to get into very much around, startups that were very high growth. So I ended up working with a company called AppNexus in New York, which was eventually acquired by AT&T for a couple of $1 billion. But I saw them go from a team of 10 people to over 900 people in a couple of years. And it was an amazing experience to watch, obviously from the standpoint of like how it was financed and how it grew. But that's really where, I got bitten by the bug of what does it mean to be in the startup ecosystem? What is it?
At that point, you were observing that deal, or you were?
So we helped them raise their first 50 million, which Taurus Ventures participated in, and so did Microsoft. So there's an interesting, which we can talk about the whole CVC angle. But there was so there's a good opportunity to kind of observe what it takes for a startup to go from early to growth to late stage. And and then having spent close to 7 years at UBS, climbing the ranks, eventually becoming a director at the investment bank, I decided to switch gears, and I realized that venture capital was actually my true calling, where I really wanted to focus on the relationship aspect of a company as opposed to the transactional nature that investment banks are usually associated with. So tied up my shoes in banking, and then decided to attend Cornell for my MBA. And really what was the motivation behind Cornell was that they're the longest and oldest business school that has a student-run only venture fund. So they select 7 students a year out of their class to be fund managers, which is directly tied into their $5 billion endowment. So it's almost like here's good amount of money, go make mistakes, no strings attached.
Wow.
And it was a wonderful learning opportunity. We just obviously had legal and professors overlooking, but all the decisions, all the due diligence, everything was done by students, by 7 of us.
So you were part of that group,
Yeah, so I
actually
was-
actively managing that fund.
Yeah, so I was the lead fund manager amongst the 7. So that was a great opportunity for me to just test the waters without any consequences.
Wow.
At least. So and things went very well. I had a wonderful time doing that for 2 years, and then of course, as I'm sure you can appreciate, being an operator before, there was a desire to kind of earn your stripes at the operational level, right? Like helping a company, rise to the ranks and grow. So fortunately, I was, hired as a senior director after Cornell at Pipedrive, which at that point was just a Series A company. It just closed its financing.
So it was just Series A.
Series A.
Because it's huge now, right?
Yeah, now it's
a unicorn, right?
Yeah, just a unicorn. It's worth about 1.5 billion. And it got acquired just last week by
Wow.
Vista Equity Partners. So great success story. And I was the first hire actually out in the Bay Area. So I got picked up by Steve, who is the former CEO, and I helped him, kind of grow that presence out for over a year, both as a full-time and also as a part-time consultant. Because at the end of the day, I always knew that I wanted to, set up a venture fund eventually. But the interesting piece here was, going back at the international thread that I was hinting at earlier, I wanted to establish a fund that could invest both in the U.S. and also in Asia. Right?
Okay.
And and then luckily things went well enough. I was able to get backing from strategic LPs and support from my personal network. And I guess so far so good.
Just by the way, before we shift more into the investment side of things, since you mentioned your operating experience, it's really exciting to been part of Pipedrive and at that stage. So you mentioned you were a director, and what sort of functional area were you in? What were you
So I
doing?
was hired within the strategy and business development division, and there were 4 of us at the time, 2 in Europe, 1 in New York, and I was in the Bay Area, and we were directly reporting to CEO who was in New York. And my sole task was, how do we get Pipedrive outside of the U.S.? Right? At that time, around 70% of revenues for Pipedrive came from the U.S., even though it was a European-based company, founded in Estonia, actually.
Right.
By previous Skype founders and all that stuff. So my job was to help them break into Latin America, parts of Asia, parts of India. So doing all that analysis, building out the groundwork there, which was very exciting. It was a
Any
fascinating
interesting key takeaway from that experience? Because that's quite a
I
process.
should say Asians are very price sensitive, right?
Yeah, that sounds
Right.
familiar,
So
yes.
especially for software products.
Yes.
Where charging premium in the U.S. is very, very easy to do so.
Right.
But one thing that Pipedrive I think did exceptionally well was they broke down everything to its very simplistic manner, right? So CRM traditionally has been bolted on with a ridiculous number of features and additional add-ons and large data sets. And I don't know if anybody's used Pipedrive here, but yeah, exactly. So I mean the simplicity of it was amazing,
Yes.
right? And that's really what got the flywheel effect going of adopting that product. And now I think it serves over 100,000 SMEs worldwide. Yeah, I'm sure generating hundreds of million revenue by now.
Wow.
So, yeah.
Wow. Excellent.
Yeah.
So now shifting gears into the venture capital side, just for the benefit of some folks, we have a mixed audience. Would you mind just sort of a quick little primer refresher on sort of the theory behind venture capital, on how a VC works, just fundamentally, really the basics?
Sure, sure. So I think maybe we start top and then work all the way down. So if we look at just kind of investment asset classes, right? We have what everybody knows, the stock market or public stocks or public markets. Within actually outside of that, there's this whole world of private markets, right? When many folks look at that just as a kind of private equity, right? And within private equity, you can kind of narrow it down even more. So when we look at private equity, that's really where you hear the names of like Blackstone or Carlyle, right? Some of these very, very large multi-billion-dollar funds. And those are primarily, their service is really to cater to businesses that have very, kind of determinable type of cash flow that they can invest into and to determine that this is a business that we can either leverage up or restructure to obviously make multiple on their investment. Now, if you break down private equity, within that world, there's a small little bucket called venture capital, right? And even within venture capital, you have three categories to kind of keep things simplistic. You have late stage venture capital, you have growth stage venture capital, and you have early stage venture capital. Where Taurus Ventures sits is in the early stage. So anywhere from an idea on a napkin to pre-revenue companies to a couple of people who've come together to really build a business, and there's really nothing there, right? So you're talking about really day one, if not in some cases day zero of companies. And that's really where Taurus Ventures spends 99.9% of our time trying to find, where Mark Zuckerberg was when he started Facebook, right? Or where the Pipedrive guys were when they started that. So that's really where we participate. Now, the nature of venture capital is obviously very, very high risk, right? Because you're investing in something that doesn't have anything determined, doesn't have a product market fit. In some cases, doesn't even have a product to begin with. So we spend a lot of time, on the team or the founders trying to understand what they're building and why they're building that. So in short, you could just say venture capital is really the catalyst of what we consider today as household names, right? Anywhere from Microsoft or Google. Back then, at one point, they were also early stage startups. And one of the, I think in my opinion, greatest things about venture capital is the impact that it has, even though being the smallest category within the private equity universe or the markets in general is, as of today, you could probably, I would say close to 65% of the US market cap public companies were at one point backed by early stage VCs. Right, and obviously a lot of it is dominated by your Googles and Facebooks and whatnot. But I think the impact that venture has, I think, is very understated. Not many people can respect or appreciate that. But but it's a lot of fun.
That number again, I was about
Roughly
65% of
all currently publicly listed companies in the U.S.
Wow.
Their first check was from a venture capitalist.
That's huge.
That's a huge number. And I think from an R&D standpoint, I think that number, and I think Stanford released a study a couple of years ago, I think it was around 83% of all R&D that takes place out of these public companies was one time backed by a venture capitalist as well.
Okay.
So the bucket is small, but the impact is tremendous, right?
Right, absolutely. So that brings us to your own effort and mission in this area. So Taurus Ventures, can you tell us a little bit about the investment thesis and what you do and perhaps some of your portfolio companies?
Absolutely. So Taurus Ventures, we started back in late 2015, early 2016. I believe our first check was in February or March of 2016. And the goal at the time, I think if you can somehow remember 5-6 years ago now, Southeast Asia was still a very cute story, right? Not many people actually understood the potential here. And I think I just had the good fortune of having lived here and seen the role of technology over the years. Obviously I have a lot of family here and also in India. So I've seen the impact that technology, could have in this region. But living in the US, in New York and San Francisco, you have a front row seat to, kind of the cutting edge business models or meeting, the next big founders or sitting across, the Sequoias or Bessemers of the world and kind of having a front row seat to what they're investing in. right? So at the time, the Valley was starting to get pretty heated when it came to seed stage focus funds, right? Everybody's strategy was the same, where we're going to invest in the Valley or in New York, all focus on early stage, all seed stage investments. But there were no firms at the time that were looking to do, let's just call it cross-border investments, right? And I think that comes from a certain degree of experiences or comfort around a VC writing a check halfway around the world and not being able to sit down with a team, every month to see how things are going. So it takes a huge amount of leap of faith or trust that you would have with that team that you back. So, I went and I knocked on doors of a lot of the large VCs, spoke to some, institutional limited partners, had the entire conversation, and everybody said it can't be done. It's just not, it's not suitable. There's too much risk. Physically it's not possible. You can't be in the U.S. and in Southeast Asia. It's too much to ask for, right? And my belief was, I don't think that was, I just didn't feel like that was a good enough of an answer, right? So I remember I was talking, to my close network, and the idea was, well, why don't we try to do a proof of concept fund, right? Why don't we just launch this and see if this thesis can actually play out? Let's see what happens.
It's interesting because that thought process is similar to a startup. It's like you're doing an MVP, minimum viable product for the VC fund.
You go through the whole customer discovery process, right? You try to figure out, and at the end of the day, like starting a venture fund is, in my opinion, not as hard as it is to be an entrepreneur running a startup, but you have to go through the same steps, right? You have to get that, and you have to raise money, you have to return money, the whole work, right? So. Did all that research and then decided, what, I think let's do a proof of concept fund. Let's see if we can actually get this off the ground. So the goal was simple in the beginning was, 2016 was invest in the best with the best, period, right? And if it was in Southeast Asia, great. If it was in the US, great. And, luckily, while I was at UBS and Citi, I had started developing my network in the venture space. So by the time we launched Taurus Ventures, we were already well networked. Right, we had access to deal flow, we had access to founders, we had access to VCs who were leading deals. So a lot of what we were able to do was the effort or the compounding effort that was had taken 5-6 years before that. Right, and that again that only came to light when I actually started the first fund. And so fast forward today, we're a sub $25 million fund. We have 35 companies in our portfolio. Roughly, I think about $2.5 billion have been raised since we've invested in these companies. We've been very fortunate to invest in some amazing founders, working on various industries. We've always stayed sector agnostic or opportunistic, only because, as you know, in Southeast Asia, there's so many moving pieces that it's impossible to identify what the next big thing can be, right? In Southeast Asia, in my opinion, they're still in kind of the fundamental building blocks of the economy, whereas in the US, things have really matured. Things have actually gone to the next stage. So yeah, in short, that's we built that, and obviously, I like to joke that eventually this will be a 10-year overnight success. Hopefully,
10-year overnight
success. Yeah. So, but at the end of the day, we're just grateful that we're supported by great LPs, and we're just investing in great founders.
Wow. Yeah. Wow. So part of what you just described there regarding investment thesis is a geographical one. It's part of it still is planted in the based in the U.S. and then part of it over here.
Yeah, right? and that's really out of design, because if we really kind of break down what's happened in Southeast Asia over the last decade or so, I would say the first innings was around kind of copy paste. Right, someone built the Uber.
True.
Some guy came here and decided to build a Gojek or the Grab. Right, but obviously tweaked or localized to the market. Right, somebody built a CRM platform in the U.S. Somebody's trying to do it here. So that was kind of the first innings of things. Right, and that's really when we were starting to get involved with the Southeast Asia ecosystem. And I realized very early that there was a tremendous lack of knowledge around, how do you actually start a company here as a startup, or how do you go about it, right? How do you raise money for it? How do you make sure that you don't destroy your cap table in your first round of financing, right? Unfortunately, I think any emerging economy has a number of sharks, which don't realize also that if you take 40% of the company at day one, you're never going to get funded again.
Exactly.
Right? And these are little tidbits that you pick up in an ecosystem that's already matured, that has been doing venture capital for 30, 40 odd years, right? So that was the first piece. Second piece was there was a real gap in helping founders in Southeast Asia connect with founders in the US who had built businesses before, who had raised money before. So in many cases, when we end up making our investment, we try to find a way to connect the CEO or the executive team to founders in the US who've built a similar business before, right? So one case in point, there's a company out in Indonesia called GoTrade, which is trying to build a Robinhood equivalent of the US, right? And when we came across them, they were just a couple of guys building a great idea.
If I may just briefly, just for the benefit of some folks who might not be familiar with Robinhood.
Oh yeah, go ahead.
Just give
Yeah,
them
sure.
just a brief.
So Robinhood is a commission-free trading app all over on your iPhone or your Android device, and I think it's been 4 years now, 4 or 5 years. It's worth a little north of $6 billion. And
For trading stock.
For trading stocks, yeah. And now they've gone into crypto and option trading. But really, they started with the idea that let's put a new user experience in front of folks who want to trade, especially the younger generation that wants to actually make investments. And super easy to use, great experience, and all electronic. No need to go through a crazy KYC process, as if you would with a JP Morgan or Charles Schwab or TD Ameritrade. And so fast forward today, they're worth I think $6 billion. They're doing incredibly well. And there's a startup that we've backed here in Indonesia that was looking to essentially build that, but their core approach was majority of folks in Southeast Asia cannot afford to buy a single share of Amazon stock, right? Let's say today, I don't know what it's trading at, 3,100, 3,000, right? That's impossible, right? For majority of the younger generation in this part of the world, it's extremely hard. So what GoTrade has innovated is essentially fractional shares, right? So if you put $10 to work, you can break that down into owning an equivalent of a Amazon share that's $10, right? And that's kind of very exciting for the newer generation here that's just learning about markets, that has that additional disposable income that they can deploy. So going back to our investment, our core there was, okay, well, the market is there, the trend is heading that way, but what can we do to help these founders make sure that they actually see around the corner, that they can see the gaps that they're going to hit, they're going to see the hurdles. So what we did was, luckily there's a fund called in the Valley called Social Leverage, which were seed stage investors in Robinhood. And I know the partners there really well. We were on the board together for another company out in LA. So to me, it was, listen, if I can get these investors involved, right, for a company here in Southeast Asia, it becomes such an unfair advantage to the company here in Indonesia to know that this is what Robinhood faced in their first 2 years, right? This is what Robinhood had to deal with from a regulatory standpoint, from a user adoption standpoint, from a customer acquisition standpoint. And that, again, comes just from stemming from the relationships that you build with folks. So luckily, we were able to make the introduction. We facilitated, those conversations, and Social Leverage ended up leading their seed round, actually. So it was the first investment they ever made outside of the U.S.
Oh, wow.
Yeah.
Wow.
So, and that's one of the discoveries that I've made, that majority of these larger funds in the U.S. today have now realized that, there is obviously opportunity here, but that opportunity is only executed upon when you have a trusted party on the ground. Right, so if I can have Social Leverage or Andreessen Horowitz or NEA look at a deal that we've invested in, the probability of that getting done is much higher than someone cold emailing or knocking on one of these.
Oh yeah,
one of these
certainly,
doors, right?
absolutely.
So that's the bridge that we've created, and that's what allows us to be, kind of competitively situated, or have more of an advantage to other funds here in the region, because many of them have taken more of a regional or local approach, which I think still works. But as we get more, because we kind of graduate to the next innings in this ecosystem, it's going to be a global playing field, right? Eventually, Robinhood is going to come and acquire a company here, right? You see Stripe doing that today, right? Stripe invested in PayMongo in Philippines, right? They opened up an office here in Singapore. So this is just preempting what's coming down the pipe. And that's kind of the unfair advantage that we have at Taurus that we've built over the years, and we're just trying to, lack of better words, exploit that for the time being.
Wow.
Yeah.
Can you tell us about maybe one or two other portfolio companies to give us a little more of the flavor?
Sure. So one of the really exciting companies that we backed just 5 months ago is a company called Bukukas in Indonesia. And I don't know if anybody's familiar with a company in India called Katabook, but Katabook essentially, revolutionize the way SMEs, or what you call it, these mom and pop shops or Kirana stores, in every little shop, kind of keep a ledger, right? Kind of keep their accounts payable and receivable in check, all via a smart app, right? Traditionally, it's been done on a little notebook, scratched out. Somebody forgets to make a payment. The father goes away, the son comes over for a week to help out. He forgets, so payments are just kind of all over the place. But Khatabook essentially, came up with this innovative model in India, where within 2 years they went from from a $0 company to $300 million, right, backed by some of the largest VCs. And Bukukas, again, is just following the trend or the success that Khatabook had. So they're doing that in Indonesia, which as well is filled with SMEs, all over the country. So we backed them about 5 months ago when they were still a seed stage company, and we co-invested alongside Sequoia on that one. So it was very, very exciting. And today they've gone on to raise a little north of, I think, $25 million in 5 months. So that's been a phenomenal investment, and the founders there are both Indonesian, but are kind of just spectacular in their own right. So that's one that we were very, very excited about. Another one in the U.S., which I think is very exciting, is a company called Unsupervised. So Unsupervised started by two founders, serial entrepreneurs, had multiple exits, and within the AI world, it breaks down into what's called supervised learning and unsupervised learning. So traditionally, when you hear people talk about artificial intelligence, it actually breaks down to what's called supervised AI. Somebody out there built an algorithm that allows you to take, pattern matching, or take this data point and correlate it with another data point. What unsupervised learning does, it allows you to make matches or connections that don't actually exist. The algorithm doesn't actually have that built in. And we backed them with Ariel Zuckerberg, actually, from Koto Management about 2 years ago. And now they're serving, I think, close to 60% of the Fortune 100 in the US. Wow. And their approach was simple, that you have this traditional model of AI, but why don't we flip that on its head and let you discover things that you may not know as a Nordstrom or a Macy's or a Nike or a Lululemon, that you can make these discoveries around purchasing patterns, or where you situate certain products in the store, like all these very interesting data points which you wouldn't actually think of unless if you have something like a unsupervised software implemented. So that's been an incredible investment that's gone really, really well. So that's another exciting one.
From the way you described it, it sounds like it enables discovery more.
Exactly.
Right.
Yeah. So it allows the algorithm to act out, right? As opposed to most computer software is very defined, or
Right.
kind of sandbox, but this one allows it to act out. If it wants to go and explore something here, which would have never been explored, it'll find some type of pattern or some type of link that allows somebody to make a new discovery around their strategy or their product placement or pricing. And that's allowed these companies to think outside the box, to find new innovative solutions. And what I love about that investment is, I think, as now companies in Southeast Asia, especially, kind of the growth stage companies or even established ones, have realized the value of data, right? Before, unfortunately, data wasn't as collected or as monitored as it was in the US, right? In the US, data has been the core to any strategy from day one, right? So there's so much data to play with, because unfortunately, as good as a software is, if it's garbage in, garbage out,
Yes.
right?
Yes.
So you need quality data to come in before you get quality results. In Southeast Asia, I'd say it's probably 3 to 5 years away from having that robust data set where you can start building these types of software companies, right? But that comes from us having that vision that eventually that will come, right? So I'm on the lookout for the next unsupervised here that can do that.
Wow.
But yeah, so those are kind of a flavor of two companies that we've backed.
Okay, because we actually have, I think, a fair number of startups in the audience too. So just in case, you already mentioned earlier that you're sector agnostic, but can you elaborate on that just a little bit more, just so in case some folks can help them consider whether or not they might be appropriate for
Sure.
talking to you?
So one of at least one of my principles is I try to take every meeting possible, right? I feel so much of at the early stage is still to be uncovered or discovered, that it helps to have a sit down with the founder, right? It doesn't matter if they have a pitch deck, or it doesn't matter if they have anything constructive, but to just learn what somebody is working on, is very valuable. And one of the, this is a hard lesson learned in November of 2015. Someone at Sequoia had sent me Zilingo, Right?
Yes.
And that's when they were raising their seed round, and I ended up not taking the meeting because I was busy with trying to set up the fund and whatnot. And people who don't know Zlingo now is, worth over $1 billion and would have been a great investment. But so lesson learned there. But yeah, at the end of the day, I try to take every meeting possible just to kind of be helpful. And I think that's one of the most rewarding parts of VC, where you're actually able to help the founder, uncover what needs to get done, or connect them to somebody else, or help them find the next, CTO or the next talent that they're looking for. So yeah, I mean, we look at everything pretty much, just from an opportunistic standpoint.
Just by the way, because I think that's part of the fabric of our own communication from even before this, and why I enjoy speaking with you. You're very, very helpful, just with other folks in the community, and you're always
I would
been
say
so
same for
nice.
you.
So thank you. Thank you. So just to emphasize, anyone out there, if you're startups, you have
please.
a very particularly
Please
nice
come
and
by.
open investor here.
Yeah.
And okay, so there's it's quite open. And how about kind of referencing back to our theme here with the U.S. and Southeast Asia? What are some of the similarities and differences between these two areas?
So from a obviously more differences and similarities for now, and I would say the differences come or stem more from the way the venture ecosystem is evolving here, right? So the U.S. has had the benefit of having venture capital as an asset class for over 40 years, right? It's been around for a while. There's a lot more players in the ecosystem. So from a fund standpoint, what's really different here is there's a lack of institutional fund of funds, right, or LPs. Majority of funds raised through the LPs are really from high net worth individuals or family offices, and then you have some kind of strategic investments from large corporates or entities or family conglomerates, if you will. Whereas the U.S. is very different, right? There's a business dedicated to investing in venture capital funds, right? So if you can make the cutoff, then you can actually pitch these institutional fund of funds or endowments, or pension funds that will be able to invest into the venture capital fund. From a operational standpoint or startups, I think it goes back to what I was hinting earlier, that there's a big gap in terms of how businesses evolve here in Southeast Asia, because again, the U.S. has an infrastructure in place around helping startups grow. There's a huge community behind accelerators and incubators, and universities have taken a massive attention to making sure startups succeed, right? I think in Southeast Asia we're still behind, and it's not to say that we haven't given attention to it. I think it's just a function of time, right? And I think Sasin has started to being one of the pioneers in trying to get startups out the door, helping that out. I know there's different types of incubators or accelerators that are popping up. Sequoia has done a great job with Surge.
Yes.
So I think over time we're gonna narrow down the differences when it comes to having access for founders to be successful, for having founders having the resources available to them to know what they're doing, right? That playbook has played out nicely in the U.S. and eventually I hope that Southeast Asia eventually gets up to that point. And the great thing about the U.S. In my opinion, culture is it's very giving, right? If you ask correctly and you meet the right people, you can gain a lot out of that. And Y Combinator, I think, has done a fantastic job of literally publicizing everything that they do, right? The startup school, for example, right? So little initiatives like this, I think that's what's going to narrow down the differences between the U.S. and Southeast Asia from the perspective of growing a startup or having the confidence that there's resources out there for you. But I think where we may need to give more attention to Southeast Asia is from a institutional fund of funds perspective. I think that has yet to come here, because I think traditional investments from large banks or endowments, that hasn't really been adopted here yet. Whereas in the U.S., that was a model from the very beginning, right? Stanford kind of pioneered that whole thing, and then David Swenson from Yale, right? The whole portfolio construction. So that there's a lot that needs to be done from that angle, and that I think is just going to take a lot more time.
I may need to double check, even for myself here, I'm understanding correctly, because the term fund of funds, when I've encountered it, has usually been in the context of someone's got a fund, and instead of deploying those funds into a startup, they would deploy it into another fund. So for example, into a VC.
Correct.
And so, a case in point, there's let's say a corporate VC, they have a pool of money, and some of that money goes into a financial VC. And the theory there is that it's a way of getting the diversification without the originator of those funds having to do all of that work, and also gives them exposure into that. So that's the context in which I'm familiar with fund of funds typically.
Yeah, so that's exactly right. But I think one step before that is somebody can set up a fund of funds versus just versus a venture fund, right?
Okay.
So if somebody were to do a fund of funds and invest into Taurus, very different than me raising Taurus Ventures,
Yes.
right? So the fund of funds would pitch the endowments or the pension funds or these large corporates where they'd be like, give us the money and we will go and allocate that to 10 or 12 different VC managers, right? Okay. And that's really where you get those big tickets, right? Where you have these endowments, writing large checks to these fund of funds to help them select which managers, right, to back. And these fund of funds also have a strategy. They'll say, 10% of this portfolio will be allocated to Southeast Asia, or 30% will be in this vertical or this sub-vertical of this sector. So that's kind of the evolution that has taken place over the years in the U.S. And eventually that will come here. But I think that's one of the, let's just call it barriers for VCs starting up, right? And Singapore, I think, has done an amazing job from a government standpoint of helping funds, kind of match or if not even, double down on
Yes.
what they're able to raise. So I think, and they're essentially copying what Israel did many, many years ago, right? The startup nation. So I think Singapore is pioneering that. And then you have Temasek and you have some larger, kind of government entities doing that. But nobody's actually formalized that process as a fund of funds,
okay.
right? So those names, if anybody's curious, would be like Top Tier Capital, right? Which backed Chris Sacca's first fund back in the day, or Steve Anderson's fund. And there's other ones, like Weather Gauge or whatever. There's one by David Kim, Sundowner Capital. There's so many that have now institutionalized the process of raising a venture fund, which allows the ecosystem to benefit from knowing that there are venture dollars dedicated to startups.
I see.
So, yeah.
Okay. Switching gears a little bit, how about looking at when you meet startups and you're trying to determine your potential fit, what's your thought process and how you vet?
Yeah, so I'll be transparent. I ripped this off of Mark Andreessen. He essentially calls it the idea maze, right? So all I do is I keep asking why, right? And I just keep asking why and why and why again, because at the end of the day, unfortunately, I think in the last, 5 to 6, 7 years or so, being a CEO or co-founder has become a sexy thing to do, right? To put it on your LinkedIn profile or to say you're a co-founder of a startup, and then a year later you fold a company and nothing ever happens, right? So I spend a lot of time just trying to understand why is it that someone is doing what they're doing, right? If you're capable of starting a company from scratch, if you're capable to raise money by yourself, you're capable to sell that vision to hire people, and you're capable to get customers, you're a very, very capable candidate to work anywhere, right? You could get a job at any large corporate and make good money instead of, going 5, 6 years with a very low salary or no salary at all and trying to make it. So to really understand why somebody is doing what they're doing is a huge piece of like what I end up doing as my due diligence process. And the best way to uncover that is asking, so why is it the way it is, right? Like, have you really gone down the idea maze of, why does this exist? Or if this were to happen, why would that not happen? Right, so the constant back and forth really allows you to discover if a founder or a team have actually done their own due diligence of understanding that are we launching something that first and foremost people want, right? Have they gone through the customer discovery process?
Yes.
Like have you gone out and spoken to your potential customers of what you're building? Right. Yeah, exactly. So that's something that YC preaches, that build something people want.
Yes.
Otherwise, why would you be spending your time and money building something that you think would be nice for you to have, but frankly nobody else really cares?
Oh, gosh. This is one of the reasons I'd love to have this kind of talk. We need more startups and more folks to hear this because this gets bypassed so often.
Yeah.
I'm shocked when meeting folks who are very passionate, very capable, but sometimes have yet to speak to a customer
Exactly.
And that's just insane.
It's insane. It really is. It really is. And it brings me back to my business school days when people always question why go to business school. But I fundamentally believe that business school teaches you very basic principles that you overlook, right? And one of the companies that we actually invested in was a company called Produce Pay, which has now done phenomenally well in the U.S. And for people that don't know, it's a company that has pioneered the way to bring financing to farmers overnight. Traditionally, U.S. banks don't lend to farmers or kind of growers because it's too hard for them to price that risk, right? To essentially put a price or risk label on a avocado or a table grape, it's too risky, right? So Produce Pay essentially innovated that. They came up with their own kind of credit risk model, and that's worked very, very nicely. But that entire process started with the founder speaking with 35 farmers and understanding like what is the bottleneck, what is being held up. And it took him a long time. It took him 4 or 5 months to do it. And of course, it helped that he came from the industry. But that when he went out, it was already applicable. People wanted the product. People wanted to use that service. And unfortunately, not many people do that. So in terms of going back to your question, I spend a lot of time understanding, has somebody asked all the questions as why, right? And then the second one is around, or kind of ties in, is around there's a thing called product market fit, but in my opinion, there's a more important thing called the founder market fit, right? You need to have a founder that actually understands what they're doing. It's great to break out of Stanford, drop out of Harvard, or some of these great schools, and then start a company, right? But frankly speaking, those are not the norm. Like, that's not the norm. That's not what majority of founders experience, right? Many of them have spent decades, or if not years and years, working in an industry that they understand intimately well, right? For somebody to launch a agriculture technology startup, you better have some experience speaking with farmers, right? You better have some experience selling into that.
Kind of helps, yes.
Right? Helps a lot. Otherwise, you're gonna hit a wall that you don't know how to solve. Like, you're not gonna be able to break through that, right? So understanding that they have the right tools and experience, or if they don't, but they're still passionate about it, that they've surrounded themselves with the right people to do that, right? And then the next category would be market size. Unfortunately, there's many cases where the market just may not be large enough. So to quantify that market, is it large enough for venture capitalists to have that outsized return, right? Because, and I think it might be helpful to talk about the drawbacks of taking venture capital, but we can talk about that next. But making sure that the market is large enough to make a return, right? And then last but not least, which a common lingo within VC world is customer love. Right, that you actually have someone that wants to buy your product, someone wants to use your service, and if you don't have that, it's okay. You just need to kind of keep reiterating until you get that, right?
Yes.
But to have again gone through that idea maze to discover why it's happening or why it's not happening is critical.
Exactly. So you mentioned the market size. To help some folks maybe visualize that, can you give some indication of what is large from a VC's perspective?
Yeah, so definitely in today's world, it has to be in the billions of dollars, right? Because if you really kind of break down the evolution of a startup, to come and pitch a VC and say we're going to take 15% of the market, right? It's unrealistic. Frankly, it's not going to happen. But what you do need to show is that you're slowly going to grow into that multi-billion-dollar market, that you're slowly going to launch new services or products within the company that's going to allow you to expand that market even further, right? So your initial market may only be 1 or 2 billion, but if all goes well, that TAM, or total addressable market, that you're chasing can multiply, right? And the evolution of that is very, very critical. So that's why we have to be so confident that the founder knows what they're doing, right? That he or she understands the metrics that they're chasing. They understand the consumers that they're selling to, or the customers that are buying it. Otherwise, it's very, very difficult to convince a VC to kind of write that check, especially at the early stage.
We meet a lot of startups and mentor startups who, if you look at their financial projection and what they're trying to accomplish in the next 5 to 10 years, you see the revenue line. It's sometimes they're aiming to make 2 or 3 or less than $5 million US in 5 to 10 years. So just a quick sanity check. How would you as a VC look at that?
Oh, so to be honest, like, especially now the way businesses are evolving, where they're becoming more subscription based, right? Because it's more conducive to the customer. you need to start hitting like $1 million in ARR, right? You want to be there,
annual recurring revenue.
right? You want to be there as fast as you can. So that roughly breaks down to, like roughly 10K, 12K, roughly a year, right? That you want to be in front of. So, I'm sorry, a month. So at this point, majority of projections, you always have to show that hockey stick, right? You have to show it. Otherwise, it's also not showing that you're ambitious enough or courageous enough to chase that market. So I definitely say you need to be writing larger numbers in there instead of just 3 to 5. But it also comes with a sanity check of, are you growing at all costs by just racking up losses, or are you focusing on unit economics, right?
Yes.
So there's that whole conversation around growth versus sustainability of that
Yes,
growth. Right?
yes.
Right. So, but although the financial model is always wrong in the beginning, it at least allows us to get a check on, are they thinking of the right levers in the business that they can pull on in order to, kind of catalyze growth more, or to allow to pull back, headcount, options, all that stuff. So it's a good exercise for any founder to go through. Yeah.
I'm glad you mentioned, because unit economics, that's near and dear to our hearts, because a lot of folks are still not familiar with it. And without it, you can be sort of misled that you have this sort of false growth, but it's not financially sustainable. Yeah.
Yeah, I think the last 10 years, frankly speaking, VCs have just subsidized.
Yes.
A lot like Uber just racked up losses. It still is, right? Airbnb has turned profitable, when they want to. But at the end of the day, majority of these companies have chosen growth over unit economics. And I think post-COVID world now, things are really going to change.
Yes.
Right?
Yes.
Very much.
We're seeing it.
Seeing it now.
Definitely.
Yeah.
And then one other thing related to this notion of market size and growth is timing of the growth. So let's say someone is aiming to get to 50 or $100 million in revenue, but how, because of the way VC is structured, don't they need to do that in a relatively short amount of time?
Yeah. So one of the things that I always tell founders when I meet with them is, first and foremost, if you don't need to take venture capital money, don't take it, because it puts you in a position where the amount you have to grow in a short period of time is truly like insane. Yes. It really is, right? But that's the way venture capital is structured, because in order for us to make returns and return money to our LPs, especially being a risky asset class, that's what's part of the game, right? That's the nature of the beast that you're participating in. Now, at the same time, some businesses are not VC backable because they're not looking for that type of growth, right? It might be more of a lifestyle business, which is great. I think those are amazing to have. But the companies or the founders that are looking to, really take that trajectory and build, something very, very big, there's nothing like venture capital out there that are willing to put those dollars to work, right? To kind of subsidize losses early on. So yeah, it's to hit that $50, $100 million mark within, 5-6 years is almost like table stake, right? You need to get that. Yes. And the other thing is, if we obviously, early stage investors like ourselves that are seed stage focused, we'll take that initial risk. Yes. But you need to start hitting those numbers in order to get the larger investors on board that will write that growth equity check, right? That will write that $30 million check to get you to the next stage. Otherwise, you're building something that frankly is not going to go anywhere, right? In which we like to call the zombies, right? Where they're sustaining a little bit, but not really generating anything, not really creating anything meaningful. Exactly. And as a VC, those are the worst investments to have, because you sell at cost, or in some cases slightly better, slightly worse, which is not ideal because for us, we need to, at least as a venture fund, look to do at least 4x of our fund size back to our LPs in terms of returns, right? So ridiculously high expectations, but at the end of the day, the only way that can be achieved is if you back companies that are chasing those high growth numbers, those high valuations that are hopefully sustainable, of course. Yeah.
So this is such a delicate point, and this is something I'm really glad to have you here to be able to help echo this, because a lot of folks in the startup ecosystem don't realize this difference between, let's say, what you call a lifestyle business and a VC fundable one. And then when we talk about these things, it's really sensitive thing, because we're not just like what you just said. Notice he didn't say make sure you go raise money from VCs. He actually said that the opposite. If you don't have to, don't. right? But it's so critical that if that is what you want to do, you need to be really clear about what the expectations are. They're distinctly different from a traditional SME or lifestyle business.
Or a loan, right? I mean, this is
Yeah,
not,
or, yes, or a
right?
loan.
I mean, you're talking about a VC coming in, taking anywhere from, 15 to 20% of your company. You better have really good reason to give up that much equity for what you're going to achieve, right? Otherwise, you're selling yourself short,
Yes.
right? And that's why I encourage folks not to take venture money if they don't need to,
Yes.
right? Because it's a very, very small subset that requires that type of capital
Yes.
in order to achieve those type of growth rates.
Definitely. I'm going to skip to, I know there were a couple of things that I wanted to ask you about, but I'm going to skip a bit so that we leave some room for folks in the audience.
Sure,
as
sure,
well,
absolutely,
okay?
yep.
So I'll just do this one about dragons versus unicorns. If I remember correctly, you were part of this article in, was it TechCrunch?
TechCrunch, yeah.
Right?
TechCrunch,
About
yeah.
this subject.
Yes,
So
yeah.
maybe just first, what is that? What is this notion of a dragon versus a unicorn?
Yeah, so unicorns are defined by any private company that's worth $1 billion or more, right? So the unicorn term was coined by Aileen Lee at Cowboy Ventures. She essentially defined that, and now it's become kind of a household name in the VC community. And what me and my colleague John Backus at New Atlantic Ventures many years ago, 4 or 5 years ago, we had this feeling from the LP base when I was working at New Atlantic was, why don't you have more unicorns on your portfolio as a venture capitalist, right? So why don't you have the Airbnb, the SpaceX, the Reddit, the Robinhood on your portfolio, right? And New Atlantic Ventures is an early stage fund. That's their core focus. So we were tasked with the idea of like, well, how do you explain this to an investor into a venture capital fund, right? And what's critical to understand here is, out of all, so that we did a study from 2004 all the way to early 2015. So a good 10-year set where we uncovered, what it means to be a unicorn and what it means to be a dragon, right? So in short, unicorns are for show, dragons are for dough, right? So really, dragons, right? Dragons is where you make the money, right, for your investors, right? You want to be investing in companies early enough where you can actually make that substantial gain for your fund. So frankly speaking, like, you can go out, and if you have the network and you have the reputation and the track record, you can get into these companies that are late stage, and you can upload it onto your website and say, listen, I've backed all these great companies.
Put their logo on
Yeah,
it.
put their logo, right? So it's like trophy shopping, right? Which is great. Okay, fantastic. But frankly speaking, where does that translate in terms of making money as a fund? Because our fiduciary duty to our LPs is to make money at the end of the day, while also being, nice to founders and working alongside. But at the end of the day, if we're not making money for our LPs, we're not going to be in business too long, right? So we went out and did a study of, okay, well, it's great that there's all these unicorns in the world, but which are the companies that have actually gone on to return money, right? And if you break it down, there were only, I think about 15 firms in the entire 10-year period that actually one investment that they made returned the entire fund. And that's the mentality that we at Taurus like to, stick with, because every investment we make, if that's not going to return the fund, we should not be making that investment, because that's not equivalent of taking a venture capital investment, right? You're better off going for, something that's going to get you to 2 or 3x, right? So we're really,
It becomes private equity. Or
yeah, it
something.
becomes private equity. It becomes, something more de-risked, which is okay. There's a whole asset class for that, which people prefer. But we're really looking to, go for that 100x, that 500x, where your entire fund is returned based on one investment, right? And those are the dragons. So our main, kind of thesis or at least discussion that we were trying to put out to market was, don't chase the unicorns, right? As an LP, you need to be looking at where are the dragons hidden? Which are the funds that have actually backed companies and gone on to return the entire fund, right? And classic examples, I mean, the top one, to nobody's surprise, was Sequoia, right? They had 7 dragons in their 10-year period, which included Google, WhatsApp, Palo Alto Networks, and these are all in mind you, I mean, Sequoia's funds are in the hundreds of millions, right? So these returns are spectacular, right? Or Union Square Ventures, where Fred runs the firm, he returned, his fund 3 times over with Twitter, Tumblr, and one other investment, right? And Zynga. So these are the type of investments that actually matter to LPs, and that's what LPs need to be looking for. And the reason we put that study together was that New Atlantic Ventures was going out to raise a $300 million fund. And that was a key analysis that we did, so they were able to launch that fund. Because at the end of the day, LPs weren't seeing past that shiny little trophy on somebody's website, right? And luckily, I guess to that, it stirred up a lot of conversation in the VC community, and now it's a term that's coined and used widely. So it was great to kind of coin something very early on in venture that gets defined. So even Jason Calacanis in his book, he talks about dragons, right? So so as an LP, that's really what you should be looking for.
Yes.
Yeah.
And just to clarify, a dragon oftentimes is a unicorn too. Is that correct? Or not necessarily? Can be. But doesn't have to be.
Yeah, but a dragon is 4 times more rare than a unicorn.
Right.
Right, which is at least within that 10 years, right? Now, I can bet that from 2000, when we wrapped up the study in 2014, 15 to today, I guarantee you that subset's become even smaller.
Okay.
Right?
Okay.
So we need to crunch that number.
And just to really, really sort of synthesize or simplify this notion more, and even double check for myself, it's that these companies you're talking about that you're calling dragons, they're returning so much to the investors, to the VCs. A lot of it has to do with the timing too, right? Like when they invest into a company. So just to make it really simplified, like if you sit around and you wait for someone to be this huge, blockbuster headline, and they're a big unicorn, and then suddenly you as a venture capitalist or investor decide to invest in them, but they're already big, it's too late.
Yeah.
You're not going to get that much growth out of that.
Right.
So this term that you've coined, dragons, relates to how and when you go in, you invest into a company.
Right. So dragons are only made if you invest in them early.
Yes.
Right. And early is, in my opinion, anything before a Series A, or in some cases Series A. Right. If you invest before then, that's really where risk is at the highest. Product market fit is just being validated. Founders are just growing the team. You're just raising that proper growth round. That's really where dragons are found. And at the end of the day, when you really break down the notion of dragons, it's also very relative to the fund size of the VC, right? So a lot of what goes into getting a dragon for your fund is based on how large your fund is, right? So when Masayoshi Son went on to raise $100 billion for his first fund, he definitely wasn't thinking of dragons, right? He was definitely thinking of, I can back some of these largest names and own them when they go public,
Right.
capture the upside there,
Yes.
right? But when you have a Taurus Ventures, right, when we're launching a smaller fund out of design, is to actually find these dragons,
Yes.
right? So from a return perspective, we're putting ourselves in the category where the probability of finding that dragon, especially in Southeast Asia, is considerably higher than doing it in the US, where you need to have sharper elbows and a lot more competition on the ground to kind of find these breakout companies. And that's one of the reasons why our fund was so well received, because when you're able to diversify the risk from a standpoint of investing early and investing in a market where things are still evolving, where there hasn't been a state of maturity for too long, you're in a really, really good position where, as a fund, you need 1 or 2 winners to really get that home run and return the fund and more.
Exactly,
right? Whereas in the U.S., still very doable, but you just need to be that much more, on sharper elbows, get into all the deals.
Yes.
The noise is much higher. There's a lot more here. Whereas here you have a higher probability of doing it.
Right.
As long as you know what you're doing, of course.
Right.
So, yeah.
You're going to go out and copyright or patent idea for a dragon corn.
Dragon.
There's no dragon corn, right?
I think somebody came up with some other ones. I think I can't remember. There was some. I can't remember who came out with a list of all the crazy
the
mystical
animals?
creatures. Yeah, all
Cockroaches.
the animals. Yeah,
and blah, blah,
cockroaches.
blah.
All that.
Yeah.
So, but hopefully, dragon sticks. Yeah.
Very cool. Well, there's so many other things that I wish I could just keep talking with. Maybe we'll probably have to bring you back another
Yeah, I would
time
love
or
to,
do
yeah.
a
No, thank you.
workshop and stuff like that. But let's give the audience a chance to ask some questions then.
Sure.
Right?
Sure. We'd love that. Yeah.
Okay. Do we have another mic to go around? Oh, you can use these on the tables. That's right. Okay. So open up for questions from the audience, please. Yes. Can you use your? Yeah.
Hello.
Hi.
Hi, thank you very much for coming here. This was very informative,
Great.
and I learned a lot. Professionally, I'm in the public equities market space, so in the same ecosystem, but very far away. So pardon my ignorance if I ask any stupid questions.
No, please.
So in my world, if somebody makes an investment and it's bad, you can just sell it on an open market, and then you just move on from there. In your world, how does this work?
Yeah, so that's a great point. So majority of portfolios, if you break down for venture funds, roughly around 30 to 35% will go bust. Essentially will be worth zero on what you've invested in. So that's money gone, right? And then you have the remaining 66% that ends up either doing okay or returning the entire fund. For the positions where we know that there's nothing to be made, there's a couple of options. One is you have the founders realize that, okay, you're actually building a business that's not truly venture backable, right? Maybe you raise money to buy us out, right? And then there's a situation of secondaries. If there's another investor who believes that they can turn around the company or change the trajectory or come up with a new strategy, we sell to them. But either case, we sell at a loss, right? So it's something that we have to write off in our books that we're not going to be able to make that multi-bagger on that investment. But what the interesting question here that you've kind of brought up is there's a huge need of trying to understand that from a VC perspective, risk is so much of what we do, right? I mean, majority of our decisions are based on probably 70, maybe 80% max. So there's a lot of unknowns that we need to uncover, right? Building a DCF or a model it's just not going to work, right, for us. We don't have any historical financials. We don't know anything. Some of these teams have just come together. It's not like they've been working together for decades or they've spun out of a large corporate. So a lot of what we do is kind of have that leap of faith, take that trust, and go on that journey together, right? And one of the hardest things about venture is, which you're kind of hinting at, is it takes a long time to know if your investment is any good, right? And you're talking about 3, 4, in some cases 5 years to know that this company is going to become something, right? We can look at it today. There's companies coming out of everywhere in the world that were doing education startups, which now overnight, post-COVID, have become worth millions and millions because everybody needs to be studying online, right? So the trend that shifted just due to the crisis has allowed these companies to come back to life. But majority of those funds have written off those investments. It was almost like nothing's going to happen, right? So it's a really delicate dance that we need to figure out and when to write off. But at the end of the day, that's why venture funds are structured to be 10 years long, because you just don't know where a company has eventually plateaued, or you don't know when the company is going to come back to life. But yeah, we don't have, unfortunately, the luxury of being able to sell even for a small loss or not. But the way we would handle it is either secondaries or complete write-off or a new round coming together. Yeah, thank you. Yes.
What are some of the deal flows that you're working on right now in Southeast Asia, and also how you manage the investment during COVID time, because you don't get to see face to face. You probably do a lot of Zoom, and how you find deals.
No, I'm so glad you asked that question. So our firm actually has been remote from day one, right? One of the philosophies that I've kind of learned over the years from mentors and folks and watching people is every dollar not used towards investment is making your job much harder, right? So yeah, I mean, given the fund size we have enough money to get a nice office space. We have enough money to do things that any large fund would do. But every dollar not spent on an investment is harder for you to kind of get to the next stage. So we've been very, very cognizant of the fact that we've been very, very low in terms of cost basis. So everything we've done, even from back in 2015, has been remote, right? We've been very, very active in terms of using Zoom before it even became a big thing, right? We were all using it beforehand. And the great thing about, the difference, one of the differences between the US and Southeast Asia is US actually, majority of deal flow actually gets shared because there's a small group of people who just have known each other for a very long period of time, who are trusted sources that you share deals with. So these individuals may be previous founders, successful founders, maybe general partners at large firms that want to invest in a deal, but it's just slightly early. But they have a close network that they share deals with. So for us, I'd say about 60% of our deals come from other VCs or other firms that we've co-invested with or have good relationships with. The remaining comes from founders that we've backed before, who've had a good experience with Taurus, who've said that, listen, this is a great fund to work with. I'd love to introduce you to new companies, right? On average, our deal flow, we look at close to 12 to 1,300 deals a year. and we invest in roughly about 7 or 8 companies a year. And we definitely have missed some, which we can talk about if you want. But at the end of the day, we've actually put ourselves in a position where we've always been remote. So it hasn't really impacted our, day-to-day activity or deal flow or investments. So we just spend a lot of time on, on the phone or Zoom or WhatsApp, or Line, where we just end up doing a lot more of the due diligence that would happen in person. Right? It'd be wonderful to have coffee or a meal with one of the founders, but for now, everybody's on the same boat. So we're not missing out in terms of, kind of like uncovering something that we may have uncovered otherwise. Yeah, so deal flow, yeah, sorry. So one deal that I think we can talk about. So there's a hyper local has become a big thing when COVID started, right? So everybody wants their groceries tomorrow morning. If they run out of eggs or milk, nobody wants to go to the supermarket and buy it, right? So hyperlocal has really taken off since COVID started, and we've just backed a team in Indonesia that's doing that. And so that's one that we can disclose openly. And another one is actually around the company is called Showplace in the U.S. And are you familiar with them, Pages? Okay, so previous co-founder of Pillow, and which ended up getting acquired by Expedia, and then another company that he sold to Chegg. And so this founder is phenomenal, multiple successes. And what he's essentially doing is he believes that the retail experience or the purchasing experience is going to shift considerably post-COVID, right? So the ability to place products in your Airbnb or your hotel room or your college dorm room or your residence, and essentially being able to pick that up on the spot and take it up to your room or keep it in your bag and take it home, that's the new experience, right? Where you walk in and you see all these products lined up. So all these brands are now realizing that we don't need to have, a store on Fifth Avenue. We don't need to have a store in the middle of, Sunset Boulevard. We can actually place our best-selling items in places where people actually want to be, which might be their, some vacation place they're going to rent for the week somewhere with Airbnb, or a hotel they always stay at, or a location they visit, and they can literally just pick that up. And it's true. So you have Diageo, you have Quaker brands, you have all these brands that are now essentially paying up front to buy the customer, and the customer essentially now becomes a lifetime customer because they've chosen to take your product home, as opposed to walking down the grocery aisle and you see 15 different cereal boxes and you choose one because you like it. But here you're actually able to try it out, you're able to like it.
It's just like taking retargeting to another level. You don't just see the ad, you see the product in front of you.
And your ROI as a company becomes tremendously high because now you've actually gotten a customer through a QR code. You have all their information, all their desires thing, and then automatically you can market, correctly. And your return on investment for that is significantly higher than, paying shelf space out in somewhere in like a Wegmans or a Whole Foods, right? So that's one that we've just backed. So we're very, very excited about that.
Wow, very cool.
Yeah, yes, that was a nice one.
Good evening, Hemant. Thank you so much for your comments. Charlie Blocker on the back row. I focus on real estate investments and other disruptive technologies. You have such a soothing voice. You have such a comforting voice to give everybody confidence. I really appreciate that in what's very imperfect.
Thank you.
The title of this evening's talk, which, Silicon Valley to Southeast Asia. So there has been considerable wealth and maturity of various family offices and funds around ASEAN, right? Mm-hmm. And you don't have to touch on every one, but maybe I'll prime the pump. But, Vietnam is 10 years ago, who would have thought they are where they are now? Thailand's watching them very closely. Singapore, just to prime the pump again with your perspective, there's a lot of, that's considered a money center on many fronts, but also there's a lot of VC and private equity monies down there. But Singaporeans generally at the margin are not risk takers. They're just don't have, it's not part of their DNA, right? Mm-hmm. So just those two examples, and then using Thailand, where we're all sitting today and is our home, my home. What would be the just sort of some snippet profiles of the risk appetite and aptitude for taking VC risk across key ASEAN money centers or sources, whether they're funding in the region or they're funding in their backyard to be in the region? This is quite relevant, particularly with COVID, where SME funding is extremely stretched. It's in fact it's anemic right now. So it's really a relevant topic right now.
Yeah, no, thank you for your question, Charles. So I think one of the important points to make here is if we take a step back, right, I think there's a fundamental belief now, especially after COVID, that if your company, regardless of it being an SME or a large established business or a family conglomerate or a large corporate, if you're not implementing technology solutions in your business today, 5 to 10 years from now, you are going to be in a ridiculously difficult spot because your cost structure is going to be higher than everybody else, your entire competitive peers, right? You're going to be at a point where you're not able to recruit talent. You're going to be at a point where you're spending so much money on things that could be truly, kind of leveraged in the sense of using technology, right? So that's the first point that, really needs to be established and agreed upon, which I think COVID has kind of put that on the map, right? You see many companies now realizing that we can work remotely. We can do things remotely. We don't have to have such an expensive real estate. There's a lot of things. And that's now trickling down to what I would say, I think we're at an interesting time in ASEAN or, just some of the countries that you mentioned where there's a significant shift of kind of succession in terms of these large families, right? And we've been fortunate to be backed by some large family offices in the region where the younger generation is now realizing that technology is a critical component to everything that they do. Right, and obviously, in order to pitch that to, the father or the grandfather family, it's very, very hard. Where you get the question of why would you invest in a pre-revenue company, right? But I think now that the newer generation is understanding the value of that, you're able to really capture, money from these ultra high net worth family offices or individuals which understand the benefit long term. Right. So if you're able to, dedicate even a small portion of, family's wealth or individual wealth towards venture capital where you're at the front row seat of what's coming next, right? Anywhere from literally like an innovative retail experience all the way to, coming up with, ice cream that's actually not made out of milk, right? Or like things where there's innovative models across various sectors, right? There's so much to be done. And I think the newer generation is embracing that. So that's one trend that I've seen happen considerably where the folks that invested into our fund are kind of the younger generation that see the value in that, right? So that's first. Second, I'd say, there's a huge adoption now, especially post-COVID, where the pace of adoption or acceleration that's happened, to becoming digital has really kind of, put its stamp now, right? So anywhere from education technology to e-pharma to, general healthcare, hyperlocal, everything, where even just looking at Thailand alone, you're talking about, I was reading that recent report that Google, Bain, and Temasek released recently, where Thailand from 2020 to 2025 is expected to grow at a 25% compound annual growth rate in terms of the digital economy. That's massive. You're talking about, I think the numbers are somewhere like $18 billion to $53 billion in the next 5 years. And that's Thailand alone. We're not even talking about Indonesia, Vietnam, Philippines. I mean, these countries, Philippines, I think is at 30%. So overall, the trend that's going to happen here, there's going to be continuing shift in adoption and stickiness for folks to adopt digital solutions, right? And that's just going to accelerate over time. And that's not a discovery or a genius observation. It's just the fact that the market is growing here, right? And you're talking about, if we look at kind of what I like to call the perfect storm, 640 million people in Southeast Asia. That's twice the size of the US, right? Mobile first generation. No one here grew up with a desktop in front of them, right? Everybody had a smartphone or at least close to a smartphone, right? You're talking about increasing disposable income. You're talking about, folks that actually want to have digital adoption. I mean, you're talking about the economy here expected to hit 300 billion in digital economy alone. And right now it's, I think, at 100 billion. So 3x in the next 5 years. It's very hard to find a story like that in today's world where you can actually ride that wave, right? That wave is coming. And then we can touch upon the public markets where yields are negligible. You're not making anything on savings account. You're not making anything on bonds, right? Families want to find yield, right? And there's no better asset class given the risk obviously associated with it that can return that type of money, right? If you can, in the next, 5 to 7 years, if you're getting IRRs of in the high teens or in the low 20s, that's a great investment versus the yield you're getting today, right? So that's a whole nother conversation, but I think Charles touches on a really important point where the wealth consideration around deployment of that capital is really going to shift from public markets to private markets, because that's really where you can move the needle in terms of generating significant returns, either as an individual, a family, institution, family conglomerate, whatever you want to call it. But that's really where things are going to shift.
Oh yeah, I'm afraid that's all the time we have.
You can take one more.
You want more?
You
Yeah?
can take
One more.
One
Okay.
question,
Good time.
Koichi.
Go ahead.
It's on Suri.
Hi, I'm Ornsuri Jinshaya. Thank you, Hemant, for your insights. So I work with the Chulalongkorn University Technology Center, and we commercialize deep tech research out of the university. We focus on two verticals. We do medtech and artificial intelligence. I'm actually here with one of my colleagues, Professor Bunrat. He's the director of medtech, and actually the co-founder for one of our more successful university spin-offs as well. So my question to you is kind of the opposite. We've heard some questions on how to source for deals, how to do due diligence for startups, but we are looking for early stage VC partners. So I wanted to ask you, what's a good way of trying to attract and find early stage VCs to kind of be our development partners and work with earlier stage startups that are more in the research phase, and also kind of how to do due diligence on VC funds as well.
Sure. So it's a twofold question. I'll take the VC one first. From a standpoint of working with the right VC partners, majority, if not all, VC funds, put up majority of their portfolio on the website, right? So you can see very clearly where they've invested, if they've invested in AI before or deep technology, or are they a consumer-driven fund or not, or B2B focus. So you can learn a lot about from just the general website. And in my opinion, what really helps is if you're truly meeting with the right VC, he or she can tell you very openly who are the active investors in the region, especially for the sector that you're involved in, right? So that's a quick gut check or a quick, kind of sanity check. Are you speaking to the right investor? Are you speaking to the right firm that actually is plugged into the deal flow? Do they know the right people, right? And that can happen over, a quick call or a quick coffee. It's very, very easy to do. So I would encourage you to do that in terms of speaking with funds. And I'd also encourage you to look at firms that are kind of regional in ambition in terms of wanting to invest in deep tech startups, right? And there's also a few accelerators out there like Entrepreneurs First, backed by Greylock and stuff, which have a deep focus on deep tech and AI and machine learning. So those are another options you can go to. In terms of due diligence on startups, of how you can kind of recruit the best, what I've realized is the best way to attract great startups or great investors is to kind of put out these thought pieces, right? What is your office's vision over the next 5 to 10 years for Thailand's deep technology sector, right? What are you going to put forward that people believe in or that see that you're chasing after? So putting those research pieces out in a obviously user-friendly manner, right, where people can read instead of having it being a white paper, that draws a lot of attention. Right, and then last but not least, being on public forums or conversations that are more publicized. I think those are helpful, but would love to be helpful for the office here and obviously the startup that you're running. If I can be of help, please let me know.
Thank you so much.
Sure. Thank you for your question.
Yeah, I'm afraid that actually has to be the last question. We're a bit late. If you have any more questions, you can actually ask him outside when you have some food. But for now, can you join me in thanking Hemant for such a wonderful discussion? And we actually have a bit of a token of appreciation for his time here today. Okay, thanks so much.
So I just wanted to also take the chance here to thank Sam. Actually, when I moved back in, I think it was 2018, he was one of the first people I was introduced to, where everybody's like, okay, you're in the startup ecosystem, you got to meet Sam, right? Some people call him Uncle Sam, right? So, but I think very few people have actually been an operator, investor, teacher, mentor. So Sam has been an incredible resource to the Thai startup community, and I think, I couldn't thank you enough for all the help you've also given me. So thank you. I appreciate it.